So let me invite our panel moderator, Jonathan Ju, Vice President of Hong Kong Green Finance Associations, Managing Director, ESG Solutions, Global Banking, HSBC, together with our panelists to come on the stage, please. The floor is yours, Jonathan.
Thank you. So everyone, if you like, you can sit underneath your picture. We've never had this before. That'll make it much easier for me as moderator. As well as for the audience. Yes, excellent. Thank you. Well, look, Tracy, thank you very much for the introduction and welcome to our third panel, where our topic, as you can see up there, transition financing and product innovation. As Tracy said, we will have some poll questions as we go through this. We're conscious we're in that sort of going into the middle of the afternoon. I know people get tired, so we'll keep you on your toes with a few poll questions to keep you engaged before we go into a conversation with the esteemed panel that we've got here. I'll just go down the line very quickly so you know everyone we've got here. We've got Winnie Fan. They've taken the names down from the top, so I'll have to read from here. Winnie Fan, Managing Director of Sustainable Finance at Bank of China, Hong Kong. My own dear colleague Luying, who runs the Sustainable Bonds team in Asia Pacific for us at HSBC. Ken Hui, he who must be obeyed, from the Hong Kong Monetary Authority. Ken seriously is a head of market development at the HKMA, and I know is very well known to many. Next to Ken, Juliet McCreasy, who is Executive Director, Head of Issuer Business for Moody's ESG Solutions. To Juliet's left, we have Olivier Menard, Head of the Green and Sustainable Hub, Asia Pacific at Natixis. I hope I've got that right, Olivier. And last in the line, but of course not least, Tai-Yi Wang, who is the Chief Business Development Officer at Hang Seng Indices. So welcome, everybody. And hopefully with that introduction, that's given you time to get to the first poll question. These are, as always, just some warm-up questions. And the question that you should now have on you, if you've got to the app, to the website, is as follows. Do you think the commitments and announcements made at COP26 represent a material step forward in efforts to deal with the challenge of climate change? And your multiple choice answers are from yes, very much, 2, somewhat, 3, not much, and 4, not at all. It was a load of blah, blah, blah. So just to get you thinking about COP26, should we be celebrating the announcements or commitments, or really was it a little disappointing? We'll give you maybe 15 or 20 more seconds to answer. Have you answered, Tracy? Good, thank you. Excellent. So the topics, as many of you I'm sure will have followed, there was a lot of talk about coal and the end of coal. There's some developments around biodiversity and avoidance of deforestation. But of course, importantly, there was an awful lot of talk about money and the mobilization of money and the 130 trillion. So how real was that? And as Ashley mentioned, I think very importantly, finally a conclusion on Article 6 of the Paris Agreement. So if we could have the answers, please, Maestro. Oh, there we go. So we had everyone sort of in the middle. We deliberately didn't ask, you couldn't score 3 out of 5. So it's 67% somewhat, 33% not much. So I think that's a mildly positive reaction to COP. I would certainly share that, and I'm sure perhaps as we go through, some of our panelists will share their views as well. But that's enough for the first question. In our first section, we really just want to perhaps just step back a bit. We've had an awful lot of very technical conversations in the discussions this morning. And as we're talking a lot about transition, I thought perhaps we should just ask the question quickly, what is transition? What is it all about? What really is the objective? What are we trying to transition from and transition to? And Ken, perhaps I'd like to ask you to kick us off on that, please.
Sure, thanks, Jonathan. And Well, great pleasure to be here. I think there is really no single definition of what transition finance transition really means. Different existing taxonomy or guidance from different jurisdictions, they all have their own interpretation and focus, very much reflecting their local circumstances. Having said that, I think there are a few common elements that we see when we talk about transition. The first is that transition finance would be doing some kind of good. It would be helping the environment to become greener, more sustainable, helping to bring about a more carbon resilient economy. And we're talking about making a meaningful difference from the business as usual scenario. So I think that's component number one, doing some good. Having said that, it's doing some good, but it's not the best kind of scenario or outcome. What we mean here is that the technology is probably the best, not the kind of cutting edge technology. The outcome is probably not the one that brings about what Paris Agreement tried to achieve. And that being said, when we talk about transition finance, the outcome is not the best, but it's probably good enough. And the onus is really on the issuer to justify why, instead of going for the best, is going for good enough and is good enough. Sometimes it's about other economic constraints. Sometimes it's about technology constraint. That's why they are not able to use the best-in-class technology. So I think in this part of the world, a lot of the time when we talk about transition finance, we have to face the very real trade-off between, on one hand, environmental consideration, and then on the other hand, social economic development. And there are also circumstances where the technology is still being developed. We talk about steel, cement. These are areas where R&D is still being carried out to find a commercially viable way to go for the really low carbon option. So I think that's very much how I see transition finance.
Ken, thank you. So I think very clearly there, it's in a sense, it's this concept that we don't just flick a switch and get to zero. There has to be some process, and there has to be different steps. And so perhaps, Olivia, I'm going to come to you in your hub. Fascinated to know a little bit more about what your hub does, but also sort of thinking about what Ken's talking about. This sort of there's steps to get to those end goals of zero. Question I really wanted to ask, perhaps you to comment upon, is do the pathways matter? Does it matter how quickly we get there? Does the shape of the pathway matter, or is it just the end point that we need to be focused on?
No, it's a very good point, Jonathan. I think net zero is a commitment. It's good to have, but more importantly, it's like in love. You need to show, you need to prove, and you need to prove of your transition. And the best proof of this transition is to have a pathway, to have a roadmap, which is well designed from today till the target, which is Paris Agreement for all of us. So to start, any company must understand which are the decarbonization drivers which are at their hands. You can exit your existing business. That's brutal, but it can be. You can decarbonize your business. You can diversify your business. You can help other sectors to decarbonize by your own activities, services, products, and you can offset. So you have 5 ways, 5 drivers. Once you have designed the use of those different drivers, then you need to design a pathway. And what science is telling us, collectively, if we want to achieve Paris Agreement, we need to reduce by 50% the carbon emission by 2030. So it gives you a little bit the idea of the steepness of the trajectory that is in front of us from today till 2030. And sustainable finance is here to accompany and incentivize those companies having not only a net zero commitment, but more importantly, those interim targets, this roadmap, this trajectory with the right steepness on which there will be interim targets that we collectively, part of the sustainable ecosystem, will use as data points to structure the right product, the right financial instruments to accompany or to embed the sustainable strategy of a given company into its funding strategy.
Olivier, thank you. And a very quick follow-up question. What happens if we go slowly? What happens to the end point? If we start slowly, is it still net zero by 2050, or what happens?
You can be, if you start slowly, then you'll be late at the end.
Right.
Because again, if in 2030 you do nothing, you don't take any actions, you start taking your actions in 2040 instead. So it means that during that period of time, you have emitted carbon.
Yeah.
So if you accumulate all this carbon, your stock of carbon will be much bigger than the one who will be starting decarbonizing and taking the right actions today.
So if we
either you have your curve, which is like this, or your curve is like this.
Right.
But at the end, if you sum up your carbon emissions, I'm not a mathematician, but this is easy to calculate, that you will be accumulating more carbon if your curve is like this, while if your curve is like this. So we need to take actions now, and this is our role collectively to incentivize our issuers and clients and investors to do so.
So your point is it's really all about cumulative emissions, and perhaps if we don't start to decarbonize by 2040, it'll mean we then need to be net zero in 2041 or something.
We can be.
Yes. Tai, so, and what's the problem, Tai, if I can come to you now? What's the problem if we fail, and what are the, and why has this become such a challenge? What do we see as the impediments to this transition having already happened? Why are we now facing these challenges to our ecosystem?
Thank you, Jonathan. I think so. For this transition, I think this is it is very well understood that if we don't keep the global warming within 2 degrees or preferably 1.5 degrees compared to pre-industrial level, it could have very catastrophic consequence to our ecosystem, our society and our life, etc. So given this, backdrop, countries, all over the world are very committed to reach, carbon neutral goal, and nations and corporations also very committed to working on this goal. And in financial industries, are also very committed to incorporate, low carbon or sustainability into their investment. I think we should understand that this transition, actually there's an inherent risk with this transition. As our panelists just discussed, there are all various kind of risks. For example, TCFD classified this transition risk into 4 categories. One is legal and policy risk. There are new regulations coming out. A lot new disclosure requirement. New products, etc. There's market risk that change in investors' behavior, change in the valuation of your investment in carbon-heavy sectors, etc. And there's a technology risk that technology plays a very important role for this transition into low carbon economy. So your investment in new technology is obviously bear some risks. And finally, there's a reputation risk. So I think we need to understand this transition risk. My understanding of transition challenges, I think there are different areas or different levels. For example, transition is very costly. That's why we need transition risk to finance it. So according to an IPCC report, that we need annual investment of around $3.5 trillion to keep global warming below the 1.5 degree. And also, it's estimated that developing countries need annual investment of 1 trillion every year to finance that, which a lot of this financing would come from developed countries. But so far, we have not reached the goal set up at last COP15, which set the target that developed countries to finance developing countries of $100 million every year by 2020. So we haven't reached that target yet. Secondly, I think different countries or regions, they are at different development stage, and so therefore they are at different stage of transition. For example, developing countries, although on absolute value, their carbon emission consists of 2/3 of the total emission globally, but on capital perspective, it's lower. So for developing countries, when they transit to lower carbon economy, it's oftentimes at conflict with their goal of improving living standard, because higher living standard often is related to higher energy consumption. Another area I think we need to think about is we need a very well thought, very well planned strategy for transition in order to avoid disruption. For example, we still remember a few months ago, there's an electricity shortage in many cities of China. So this is probably due to the conflict of reaching low carbon target with the surging demand from on goods of after reopen of COVID. So these are all the challenges that we would face when transition to low carbon economy. For financial industries, I think it plays a very important role in helping this transition by encouraging, for example, more transparent disclosures, as well as offer products and solutions for investors to choose from to direct the capital into low carbon economy. But there are challenges still. One is data, because so far there's no consistent standard or framework. So a lot of times there are data gap or inconsistent disclosure requirement, which prevent investors to compare different investment and make decisions. Another issue that prevents investors to invest more into this area is because of lack of knowledge from investors. A very common misconception among investors is a lot of times they believe that investing in low carbon or ESG related portfolios would oftentimes result in negative returns. However, a lot of research by academia or by practitioners show that this is not the case. For example, at Hang Seng Index Company, our ESG index as well as our newly launched ESG Screen Index, their performance all beat the underlying Hang Seng indexes. So I think investors need to change their perception.
Yeah. Tae, thank you very much. I'm going to come back to you on your point on the role of indexes, but I think your summary there in terms of it's costly, it's disruptive, we don't quite know what to do, we don't have the information to make the decisions that will make the changes. So that sort of inertia is stopping us making the transition. But Winnie, I want to bring you in here and ask you sort of to, complementing what Tae said, it's costly. What's the role of money here? What's the role of finance in supporting the transition?
Greening the economy will require a huge amount of capital to fund the innovative solutions and to commercialize the technology available at a scale and pace that is equitable to all as possible. I think the financial sector has a unique position to drive the transition, given their extensive client network, together with the market knowledge and experience across all economic sector. I would say that there are 3 major roles in driving the transition for the financial sector. The first is the reallocation of capital, which is also the most important role. Financial sector, I think, should develop green, sustainable, and transition solution with an objective to scale up and redirect capital towards the zero target. To do so, we need to leverage on our financial expertise as well as the relationship with our clients. So financial expertise should be leveraged to promote innovations on products such as the corporate debt and equity issuance, which ties to the terms of lowering emission. At the same time, we need to develop and support new services and tools, such as carbon market derivatives, to help developers of capital to manage the risk. And the understanding of a client's transition path is also essential, so that we can support their low carbon and climate resilient investment with adequate fund and proper solutions. The second is risk management. I think with or without regulation, financial markets are directly exposed to systematic financial risk posed by climate change and transition. Therefore, it is important to for us to incorporate such risk into our existing risk management framework. This is also to ensure the role as prudent and responsible financial intermediary. From driving the transition standpoint, financial sector also has to play the parts in safeguarding against greenwashing risk. So, which can be achieved by better information disclosure, more robust grading and verification system, and after all, protecting the integrity of the market is of utmost importance. The third role, I think, is as a green champion. I think we should take one more step forward in advising our client on their transition journey. This includes awareness building and sharing with them the best practice, the latest regulatory requirements, and industry trends. For lots of our clients, we notice that they are very proactive in decarbonizing their facility and operation. I think we can also help them to increase their awareness building, and we notice that they also would like to understand more about what green finance is. So we will understand their initiatives and participate in their formulation of the transition plan. In order to create a sound market, the role of taken by the financial sector is also to accelerate the learning process. For example, we can develop sample cases to further help the market to build capacity on green finance, especially in the market when the market is in a starting stage. And during the process, positive attitude of the client to take on challenge, the understanding by the financier, and the proactiveness from both sides, I think will be required. So for sure, I think financial markets plays a major role in contributing to the transition. And I'm confident that we are embracing the new mission with passion and determination.
Winnie, thank you for that. I think that's an excellent sort of menu of things banks and finance industry should be looking at to address the challenge. And the bit that struck me was sort of how your comments there, particularly where you were talking about the reallocation of capital, sort of echoed what Ashley was saying in terms of the objectives around disclosure in his talk. So at this point, I hope this has been a sort of a useful sort of reset of the foundations as sort of what the challenge is, what's the problem, what are the pathways we need to look like, and the role of finance. And picking up on Winnie's point on reallocation of capital, our next poll question gives all of you, some of you may already be allocators, but the opportunity to decide how you would allocate capital. And our next poll question, if we can bring it up very simply, is, if we can bring that up onto the screen, should investors and financial institutions divest from non-sustainable investments such as fossil fuels? And this time it's a yes or no answer. Should financial institutions divest away from fossil fuels? Ivy in the front row is smiling. She knows that's a deliberately controversial question, just to get everybody focused into the next phase when we start to talk about some of the innovation and solution and what the financial markets are starting to, how they're connecting capital to its investment needs. So if we could have the answers up, let's just see what people said very quickly. have the results, guys? Oh, quite a 62% said yes, 38% said no. What do you think about that, Ivy? I suppose that means probably everybody's right, yes? No right answer to this question. But let's explore into that, and let's get into this important topic of transition finance and innovation. I invite my colleague Luying just to talk about sort of where are we today and where's the market, what products are out there that are sort of supporting the transition along the lines that Ken described earlier. Just tell us where we are today, what's out there.
Yeah, thanks a lot, Jonathan. I think it's really encouraging to see those answers to those interesting poll questions. And then I think Hong Kong GFA is our annual meeting, annual general conference today. I think I would, may I describe it as a Hong Kong version of COP, where we gather all the industrial experts here and talk about the sustainable development of Hong Kong, Asia, and globally. So I think Winnie talks about that. I think as a financial institution, I think that we would need to reallocate capital in order to support the sustainable development. I think that's for financial institutions, but I think the capital market is actually also playing a big role here. So I think you may hear about that the sustainable bond market has been growing extremely fast in the past few years. And then in 2021, we are well on track to a global $1 trillion issuances. So $1 trillion. And then from this end of the world in Asia Pacific, I think we see actually two very encouraging trends in the capital market, especially in the sustainable bond market. The first one would be that the percentage of sustainable bonds versus the whole bond market is actually increasing. The latest stat from HSBC's database is that in Asia Pacific in 2021, more than 15% of all bonds that issue in the Asia Pacific market is in sustainable format. So it means that it's 1.5 bonds out of 10 bonds are either in green, social, sustainability, or sustainability link. And then in some key markets, for example, in India, Korea, this percentage can be as high as 40%, so it's 4 out of 10. And then in Singapore, in Hong Kong, and in Indonesia, it's about 20%. So 2 out of 10 bonds issued out from those markets are actually insustainable. So I think this kind of supports the poll answer about whether we believe that non-sustainable investment should be diverse, so it would need to be get rid of. So it is not exactly that, but we do see that more capital are actually being diverse to those sustainable bits of the capital market. And then we have seen many of the innovation this year. I think one part of our panel title is product innovation. So from corporate, we have seen sustainability linked bond SLB, which has been issued by many organizations in the world. And in Hong Kong, we have seen NWD, we have seen Ultra Tech Cement from India. And for financial organizations, like Winnie mentioned, we are not only using our lending book to do the sustainable activities, we are also issuing bonds to fund that. So for example, UOB from Singapore has issued the first tier 2 and senior combo bond in sustainability format, which is actually combining the green label versus the capital security structure, which is the most advanced in the FIC financing. And then we have seen Axis Bank from India, it's issued the AT1 bond in sustainability format as well. So for banks, we are not only utilizing our capital wisely, but also we are specifically targeting the sustainable part of the capital market and the portfolio of the project. And then in government in Hong Kong, Ken is one of the main driver, and then Malaysia, Indonesia, they are also using their capital market activity in order to drive the development of the sustainable and the green and sustainable portion of their investment. So I think I would say that for now, we have more tools in our toolbox to support the transition from high carbon to low carbon, as well as also improving the living standard in many of the developing countries. So I think some of our panelists mentioned that one of the key challenge, especially for developing market, could be that the green project would be relatively expensive. So if we would like to transit to green overnight, then some of the consideration of socioeconomics may need to be overlooked. So I think each country would have their different pace on how to do the transition orderly. The capital market, like the bond market, is definitely there to help. On our panel, we haven't got an investor here, but I'm sure that there are many investor audience in here. So you are the money owner. You are also a big driver and powerful force about diverting the capital into the sustainable bit of the capital market. We do expect 2022 would be another big year for sustainable bond. Let's make our wish list to see what is going to happen. But one thing is for sure is that we would like to see the capital market being greener and greener, and then being more sustainable day by day. Yeah.
Luying, thank you. So volume is very significant. Clearly, those percentages you referenced, this is no longer a niche product. This is becoming mainstream, between 15 and 40% of issuance, I think, in those markets. You referenced lots of different sectors that are being applied, different credit structures from bank capital and so forth. And as you said, lots of tools in the toolbox. But how do we know which of those tools in the toolbox are green or truly sustainable? Juliet, in your role as in a sense, the private sector police and regulation of what's green, what's sustainable, what's genuinely fits those, and what may just be a hollow promise. How do you go about that?
Thanks for your question. So just maybe before answering that, I just would like to reinforce the fact that the SLB market that has mentioned by Luying is definitely a game changer in terms of development of the private capital into sustainable finance. It's really answering, the issue of needs about that we're not able to go to use of proceed approach, to go to other tool as mentioned. We define KPI, and we speak about inclusion of sectors, inclusion of company. But with SLB, I think is something that will be more meaningful, as we highlighted some recent research sector, and we realized that shipping, oil and gas, mining and metals represent only 3% of the label bonds today globally. So there's a lot of room for growth in this sector, where investors are probably now more ready to invest and look to finance green capex if it's aligned to the visible transition pathway and the viable transition pathway. So I guess it's where our role as the external reviewer is coming, is to make sure that this pathway are the right one, are making sense in terms of what we can expect from corporate, depending on their sectors and the industry of their countries. Just as a preamble as well, we are always using the methodology and the same principle, international principle, when we provide independent opinion. So we always refer to the ICMA principle, which are the green bond principle, SLB's principle, and so ever, just for comparison reason and harmonization, and not to confuse the markets. So whatever is the labels, our role is to provide transparency and comparability for the market. And it's true that green bonds, transition bonds, SLBs, they are all really good candidates to leverage and finance transitions activity in SMEs. So what it is important, and what are we looking at? We are looking at having this tool make it effective and improve, so they really facilitate a transition to more sustainable business model. And just to avoid greenwashing and make sure there's still the market integrity. So basically, we have to always to look at enhance our methodology. The SLB market in this example is 15 months old. So we are viewing more issuances, more sectors, and so we are all learning about how best address this market, and how we need to enhance the principles, the standards, the methodology, to make sure that it's relevant and it achieves its objective. For example, we have improved enhanced ourselves, our own methodology on this sector to better capture both the materiality and the relevance of the KPIs. And we are using now a quantitative sliding scale. So using more and more quantitative targets, it's something to provide more confidence to investors, to stakeholders, in how they can compare and measure and understand what has to be achieved. So, for example, we quantify now the scope of selected KPIs in addressing entity core sustainabilities, and its business strategy. And in terms of materiality, for example, of the KPIs, we'll take that into account based on the current and future operation of the company. So our materialities for this specific sector and for these specific companies. It's especially relevant as, you know, after 15 months of experience, a lot of SLBs were using GHG emission as KPI. So this is good, but what do you need? And so, for example, where scope 3 emissions represent more than 40% of the overall total emissions, we do think that it's kind of highly required of mandatory if they want to achieve a good scale or good rating from our side to have this scope 3 included. So this is all this small incremental enhancement that will allow us to have confidence in our market and in the sustainable finance market that we are all creating. So this is really the ideas of the KPIs must be ambitious, and we provide the right and the positive signals to investors. I will just finish on something which is really important because we're speaking about transition and climate transition. It's about the materiality. It's something that we always looked at, and we also look at the dual materiality, which means it's not only the impact of ESG factor to the company itself and its financial profile or its long-term profitability, but as well how it impacts the society and the environment of the company. And for climate, it means that, you know, the materiality of the climate change on the company overall business strategy is something that will be more and more looked at. And now, so of course, some threshold needs to be set up, but we cannot use some general threshold. It has to be specific to the accounting standard or specific to the industry. And again, what will be really essential in this space for climate transitions, materiality is to use quantitative threshold, quantitative KPIs, and as much as we can improve our climate disclosure, as much as the market will be as well developing in a proper way.
Juliette, thank you. If I can just dig into a couple of details on the points that you mentioned there, very quick questions. The first one is around, you talked about scope 3 emissions, and you said if you're in your business, you have a big scope 3 impact, you should be measuring it, or there should be a target, or there should be both?
It should be one of the KPIs. So if a company has got a lot of scope 3 emissions and she wants to do an environmental KPIs based on green KPIs, and she forgot, unfortunately, to choose the scope 3 as one of the key KPI, we do think that is not really represents the activity of the company, and she's right. And of course, I'm sure that the KPI that she will be chosen will be relevant, but will be as material enough to make sure that the company is focusing on the right trajectory.
And is it
so
okay?
There could be a combination of KPIs,
yeah.
But it's something that needs to be pointed out, because in some cases you could choose some really great KPIs, but that not so much relevant for the company. So we are losing the momentum somewhere.
And is it okay just to have a target, or do you need to have an incentive embedded in the financial transaction as well?
Usually, it's, you know, having both, of course, is really better. It's really better, but it's all depend about the business model of the company. I would
Sure.
say.
And the other question I just want to ask very quickly: when you do your assessment, you talked about this sort of client level assessment of the validity of their transition plans, or so. I think I've quite got your words exactly right. But are you assessing that and their commitments against the pathways that Olivier was talking about earlier, these sort of Paris Agreement aligned pathways? Is that what you do as part of reaching your opinion?
Yes, this is at different levels. So that's, of course, how it is integrated at the company level to have their own sustainable strategy and journey. But is it ambitious towards more international standards or industry, and of course the Paris alignment trajectory? So we have to put fix into context. So whatever the investor decide to go on or not for this bond, he needs to understand how ambitious at the end is this instrument.
Great, thank you. Olivier, we've talked a lot about sustainability linked bonds. Luying was giving I think, a bit of a seasonal message earlier about wish lists. What else might be on your Christmas list for new green and sustainable financing products that you think might be around the corner or should be developed?
Jonathan.
Or
Yeah, right timing just before Christmas. So what do we need? What is missing? Or if I may ask the question differently, what are investors looking at? What else? Robustness, discipline, clarity, transparency, all those words, you know. Sustainable finance needs to be disciplined on a number of topics. One is transparency from the issuer side, so full transparency on the energy transition, on the pathway. We've discussed that before. On the advisory side, as a bank, we need to properly advise our clients on the way they should design their KPIs, design their targets, using proper methodology, using science-based methodologies when it comes to GHG emission. This is key. Scope 3 is key, is core. And we need to resist to our internal, to the internal influence within banks, external influence, corporates, when it comes to dealing with margin adjustment mechanism. Sustainable finance on loan side there is a symmetrical approach. Either you achieve your targets, you get a discount, either you fail, and there is a penalty. I think it's important to remind everyone, and it's core to the exercise. What is missing? ESG data, accuracy. Clearly, I mean, we are all lacking for ESG data here. This is if Santa Claus could come with ESG accuracy, that would be fantastic. And last but not least, and Juliette is here next to us, making sure that indeed, as you said, the private police is here to protect the overall ecosystem, making sure that the review is done properly. So all those points are important for a very good reason. Sustainable finance is a new baby for all of us. It's new to the banking industry. So the credibility of sustainable finance is at stake. So we need to protect this environment. We need to be more robust, more disciplined.
Olivier, thank you. Luying, back to you. Other innovations. What else do you think is out there?
I think speaking back from the capital market point of view, I think we hear about quite a lot of challenge that the sustainable finance market is facing. I think part of it is due to the capital and the pricing inefficiency. So think about that, because some parts of the society is actually producing the high quality good, but actually, for example, the developing market has been undertaking many of the manufacturing of the hairy good, which would be quite polluting, and then the consumer is actually in the developed market, so it creates kind of an inefficiency about the pricing. So who extract the carbon and who consume the carbon, who should be responsible for taking care of the damage. So I think there will be a long-term discussion in the capital market is about the carbon pricing, right? So we talk about many of the investment that would need money, and then the company who invest in green project and social project, it would need money. But who is going to pay for the money? Where does the money come from? I think the carbon pricing would be one of a good mechanism. So if you fully price the carbon into the pricing of your financial instrument, your internal strategy setting, that would be offering quite an efficient way to handle the inefficiency. So I think we have a poll question about whether the COP has been achieving a lot. I think one of the maybe some area that falls short of the many of the international audience about COP is about the carbon trading mechanism, the international carbon trading mechanism. It has been discussed, but may not have really concrete implementation plan yet. And then I think many countries, so for example, China, for example, the EU has been developing their own carbon trading system, which would definitely be beneficial. So I think we are moving a little bit closer to carbon pricing. only when the carbon can be correctly priced, and then can all the issuer, investor would be able to take them into consideration when they do capital market transaction. So if I need to put out one wish list in my 2022, I would think that maybe if we can develop the carbon pricing a little bit more, then I think the whole market would actually flow through. So if it's more expensive to do a fossil fuel project, and then I think people would naturally move to renewables, right? So I think it's a really, really simple about demand and supply, and then about solving the inefficiency in the capital market.
Great. So that's carbon pricing on Luying's Christmas list. Robust, well-policed transactions on Olivier's. If anyone else on the panel has got any product innovation suggestions they'd like to raise now, please do. Otherwise, we'll perhaps go to the next poll question before we go into a discussion more about supporting and facilitating market development. If we could have our next poll question up, please. Here we go. This question always comes up in Hong Kong green finance events, but I think it's very important. I think it links back to, again, something Ashley raised in his very good talk just after lunch. How strong is the green and sustainable finance ecosystem in Hong Kong? And again, you get 4 choices. We've confused you with the numbering here, but an answer of 4 is the strongest and 1 is the weakest. And yet again, there's no option to pick medium here. So is Hong Kong really delivering on and taking advantage of its opportunity as a fantastic green finance center to support the transition? I think we've heard today from how good and strong our regulators are across both the prudential and the securities market side. But could we do better, perhaps, is the other way to ask this question. Not just of the regulators, but amongst the participants as well. Do we have the capacity in the market? So 4 for the strongest, 1 for the weakest. If we could have the results in, please. Great excitement. And we've got, wow, 59% said 2. So that is, assuming people weren't confused by the numbering system there,
So it is strong.
where 1 was the weakest and 4 was the strongest, we are below par, and i.e. worse than average, not below par in the golfing sense. So we're slightly poor versus average. So some work to do, Tracy, I think. Anyway, look, let's now perhaps focus on that a little bit in the next section. And I want to come straight back to Tai, because you started in my sort of earlier question to you to talk about, how indices can play a role in helping to direct capital more effectively to where it can have greater impact. Please tell us a little bit more about that, Tai, if you wouldn't mind.
Sure, thank you, Jonathan. So as an index company, although we are not in the financing, business, but we still play a very important role in helping with the transition. So Hang Seng Index Company, we are very committed to addressing investors' demand in low carbon and sustainable investing, and we are committed to help Hong Kong transition into a green and finance hub. I think the first important role that an index can play is to serve as a very valuable benchmark or reference for investment products to track, so that for investors to allocate their capital to the low carbon, green economy. So we actually, we at Hang Seng Index Company, we started our sustainability, index journey actually quite a long time ago. We launched our first sustainability index back in 2010, and over the years we have offered a suite of ESG or sustainability indexes for the investors, including For example, the best-in-class indexes that I just mentioned, including also thematic indexes, such as we launched earlier this year, the electric vehicle and clean energy indexes, to indexes that take a more integrated approach. Actually, just yesterday, we launched 2 new indexes. One is the HSI ESG Screened Index, and the other is HSI Low Carbon Index. So both indexes refer the Hang Seng Index as a base index. So takes the constituents, but apply some tilting so that the constituents weights are adjusted to overweight constituents with lower ESG risk or low carbon emission. And these 2 indexes actually offer very good performance. For example, our ESG Screened Index not only improve the ESG performance by 11%, but offer more than 2% of excess return on an annual basis, while track the underlying HSI index pretty closely. And our low carbon index managed to reduce carbon emission for the weighted average carbon intensity of the index by more than 66% compared to the underlying base index. That means the low carbon index, the carbon intensity is only at 1/3 of the underlying base index, while at the same time we offer a slightly better performance and very close tracking error. So I believe those indexes would help, offering investors with options to allocate their capital into ESG or low carbon area. So that's one role that we can play. Another role I think indexes can play is to serve as performance benchmark. A lot of times, investors, when they invest in either sustainability or low carbon investment, a lot of times they find it's very difficult to measure the performance. So how or which they should measure their performance, against, either against the historical performance or against the peers or whatever. I believe the ESG or low carbon indexes would serve this purpose. For example, they could compare their portfolios ESG performance improvement with our ESG screened index to see if it beats our benchmark, or they could compare their portfolios weighted average carbon intensity, see if it outperforms the index. Another role I think the indexes could play is, although we are not in the financing business, but we could still play a role in this area to serve as a reference, as a sustainability performance target. When issuers issue loans, issue sustainability-linked loans, a lot of times the lender would require the issuer to meet certain sustainability target. So our index could serve for this purpose. For example, in the marketplace, there are quite a few loans, sustainability linked loans issued, such that the lenders require the issuer company to be listed in our corporate sustainability index, so as one of the performance benchmark. So in this sense, index could still play important role here. So I think all in all, although we are not in financing business, there are still very important roles for index companies to play, and we are very happy, very committed to help investors with their transition journey.
That's great. Thank you, Dave. I'm very excited to hear your 2 new indices just launched. Just out of interest, I'm just wondering, how closely correlated are the weightings under your ESG screening and your ESG low carbon indices?
Actually, the methodology, although the framework is pretty similar in that both indexes take the base index HSI constituents and tilt the weight. But the two indexes has very different focus. One focus on the ESG performance, one focus on the carbon emission. So although methodology-wise it looks similar, but the weighting are different and the performance are different. So
do you know what would be the biggest ESG factor that is not low carbon?
ESG, it consists of three pillars. Environmental, obviously, is related to low carbon, but on social and governance, it may not necessarily related to low carbon. Like social, we care about employees, we care about our customers, we care about product safety, etc. And on governance side, we care about board independence, we care about remuneration system, etc., etc. These are might not necessarily directly related to low carbon.
So reiterating the points we had earlier, and a very good question somebody asked, is not just E, but the S and G are material to risk as well, even though they're probably correlated. Great. So Ken, back to you finally. How can the central banks and regulators support this process? We've heard about the challenge, we've heard about what markets are doing. How, in your minds, are you taking action now to support the development of these markets?
On promoting green and sustainable finance in general, we've always been focusing on three pillars. The first is regulation, and in particular risk management and disclosure. So we want to make sure that our financial system is climate resilient, and we also make sure that investor as well as financial institution, they have the necessary information to allocate capital and to steer company decision towards the climate resilient low carbon future. And that's why we're introducing things like risk management for banks, as well as supporting the International Sustainability Standard Board and to mandate the TCFD disclosure by 2025. So that's one key area. The second key area, I think the poll result kind of very soberingly tells us is on ecosystem and infrastructure. Here, our focus is more on talent and data. We hear Juliet talking about the use of quantitative methodology in the assessment. And I think this is really very important as we go forward to enhance the credibility and robustness of our regime. So making sure that enough data is available, making sure that enough talent is available to analyze those data is one of our focus. And that's why earlier in the year, we set up the Green and Sustainable Finance Center, hoping to put together, gather the industry as well as academics expertise to develop initiative as well as to do works to enhance these two areas. We're kind of nearing the first phase, the end of the first phase, so we're hoping to announce some of our work result really soon. The third area that we focus on is awareness. Traditionally, we've been focusing on awareness among institutions as well as the public. So, for example, the HKMA has been leading by example by integrating ESG methodology in our investment approach. As Luying has mentioned, we've also been helping the government to issue green bond. So we've just done 3 tranches of institutional issuance, and we'll be doing a retail one really soon. In relation to transition finance, and I think these 3 pillars generally apply, but there are certain additional areas that we believe we need to focus on. I think Tai and Olivia both mentioned disclosure, and here we very much agree because I think more than just traditional green and sustainable finance, transition finance, there's a lot more uncertainty as to whether an issuance or a product really qualify for this label. So here, the issuer really need to do more to explain to investor why it's choosing this particular path rather than the best-in-class technology, to make sure that there is credibility to its transition pathway, its transition plan. And for investors as well, they need the additional information to do the analysis. So having more disclosure, I think, is one extra kind of condition for a thriving transition finance market. And here, things like the ICMA transition disclosure guidance, I think, is really very useful. The other area is on awareness. We talk about institutional as well as retail public awareness, But here, I think there's an extra awareness among, us, the public body, or kind of the international community, so that they know, particularly in this part of the world or in emerging market, there really is a need for transition finance. We need to kind of go out and explain to them, why this is necessary, why we can't go always for the best in class. We've been kind of trying to do that at international forum, regional forum, and, to the extent audience here, other panelists have the opportunity, we'll encourage you to do the same.
Great. So transition finance on your Christmas list, perhaps, Ken. And when you say not best in class, I'm sort of interpreting that you mean we need appropriate standards for the state of development of the economies in the region that Hong Kong serves as a finance hub. I mean, we're not suggesting that people can go easy because we're in Hong Kong. We've got to be going pedal to the metal to drive the transition as fast as possible. I think that's what you're saying.
Very much agree, yeah.
Yeah, okay, good. ESG ratings, building on what Ken's saying, another piece of market infrastructure, sometimes criticized, Juliet, they're not correlated, and how do we use them? What do you see as, obviously you're in that business, how do you see those developing? How are you working to make those more helpful to the overall effort, even more helpful to the overall effort?
Yes, it's true that there's a lot of different, there's a lot of news and articles highlighting the fact that there's no such a big correlation between different ESG ratings for different providers. And I think it does reflect a few things. The first thing, it reflects the wide range of different approaches for ESG, but also the fact for investors got different views and different approach and values ESG. So the different ranges, for financial materiality to some specific sector factors that will be taken more into consideration in some ESG methodologies, such as human rights or climate or something, but as well on data collection and impact measurement. So we do think that there's no, at this stage of development, there's really no one correct answer on what should ESG measures. But what is key is to have a fundamentally driven principle approach when you measure ESG that are based on integrity and transparency and harmonizations. And then if we are clear on this principle and methodology, then it will be really the investor choice to use one of the other ratings depending on how they want to use it and their choice and value. By saying that, we should as well take into consideration the fact that ESG factors and climate factors are becoming more and more important in all investment decisions in the banking system, and in the banking system more and more now. Banks are taking ESG and climate factor into their rating assessment process and not and integrating that to potentially adjust the creditworthiness of the company they are lending to or they are dealing with. So this is really important to measure properly ESG, how ESG factors or climate factors can impact the long-term profile, can impact the profitability of the debt profile of the company, especially for the high transition sectors. So sectors where, the transition will be complex and will be costly, because it will require divestment or investment in such an area. And our role as ESG provider is to provide enough ESG data and information so financial institutions or stakeholders can take that into account and get an assessment on the impact. How much will cost if there's a change in climate policy to this company? If the company has to retrofit some production facility, what investment are needed? So at the end of the day, financial institutions should get a sense of how much they should adjust the creditworthiness of the companies because of ESG or climate factors, and they should be able to answer the question of, on this specific company, the transitions towards a more sustainable operation model. How much does this cost? Can they finance that? Can they fund that? And another flip-flop aspect of that is the liability side of ESG. We need to get an assessment of companies facing ESG liability can at the end come to a default or have enough fund to be able to face this potential ESG material utility. So I think it's really where we are today to make this linked, depending on your views and what is the angle of your investment.
So would it be reasonable to say that we shouldn't be expecting a correlation between ESG ratings from different providers, but we should be expecting that they're all based upon robust data and that the methodologies are transparently disclosed? Is that a fair summary?
I think for now where we are, it's what is the most we can do. It's having transparency on this methodology, making sure that the data used are really clear data, and then making sure that it is understood by the user and so the corporate itself when we ask for data, how it will be used in your ESG score, and on the other hand by the investor, so they understand what they are looking at.
Great, thank you, thank you. I'm going to ask a last question at this stage, and then we'll open up for questions from the floor. But so please do think of your questions. Bring forward your innovations. Bring forward your solutions to pushing Hong Kong up or improving the Hong Kong green financing system. But my last question is to you, Winnie. And listening to what you've heard and from your own experience, do you see how far is the private market, the private finance market's going to take us on this ESG journey? And where do you see the need for stronger impetus for regulation and perhaps even for industrial policy to drive us if we're going to meet these very ambitious targets?
I believe that a successful transition to net zero will require extraordinary level of cooperation across all stakeholders from both the public and private sectors who interact and complement each other. It is great to see that Hong Kong has been reacting quickly in the past few years. There have been a lot of encouraging progress made. Thanks to Hong Kong government's policy support so far, and also the GSF cross-agency steering group that strengthens Hong Kong's financial ecosystem to support the green activities. Also, HKMA, Hong Kong Exchange, SFC, have been at the forefront in engaging with the market participants for setting supervisory expectations, carrying research on climate-related risks, etc. But given the scale and speed required to achieve net zero, I think further policy and regulation support to direct the capital is of critical importance to ensure that the market participants receive the proper support to translate the net zero ambition into actions. I would like to share some thoughts on this. First of all, with the support and guidance from MA and Hong Kong Exchange, we see a lot of financial institutions and listed companies intensifying actions on greening the economy in the last few years, with more policy and support emerging in parallel to guide the broad-based economic sectors, such as including the SMEs. I think it is expected to have to drive an even more deeper and active market. Secondly, investors rely on credible data to evaluate climate and transition risks, and such data collection capabilities and requirements need to trickle down to all levels of economy for the longer term. Further, the standardization and disclosure of environmental-related information will help to achieve this objective. Also, the adoption of the common ground taxonomy will also provide better framework to further encourage green finance and investment. Thirdly, incentives could be developed to direct capital into certain priorities. For example, to incentivize innovation, policy support can be given to the development of breakthrough innovations in clean technologies. Government support can also be applied on green-related investment by measures such as co-funding for projects or by mechanisms such as risk sharing through insurance and guarantees. Also, incentive we consider to be given to the financial institutions by lowering capital requirement on lending to certain green projects. Furthermore, it is also important to have policy support together with proactive measures taken by the financial sector to help Hong Kong develop into a green financial hub and regional carbon trading center. This strategic role will enable us to be mainland's gateway and mobilize capital in a more efficient way to facilitate the national carbon neutrality goal. Last of all, just as that, capacity building is also critical, I think, in every sector. Government has already been doing a lot on this together with different bodies. I think all decision makers should finally be well equipped with the knowledge in greening the economy in order to achieve a timely and smooth transition.
Brilliant, thank you, Winnie. And that word collaboration coming across very strongly as well. I'm not going to ask Ken your question about will regulators give capital relief for green activities, because Ken is from the market development side, and Arthur's not here, but you can take that one back for him, Ken, when you get back to the office. But I will pick up a couple of questions, and please, anyone who's got a question in the room, personally, I always prefer them from the room, but there are a couple of interesting ones that haven't been covered that have come through on the Q&A here, and they're really for the bankers. So there's a bit of a question for you, Luying. How do you measure the additionality of your green bonds? Or are you just raising green bonds that could have gone happily to market in non-green format? So what's the benefit or the additionality of a green bond? And while you answer that, just to tee Olivier up, there's a question here as well. You know, should banks generally be giving more help to their client to help them develop decarbonization plans and transition pathways? But Luying, perhaps you take the additionality one first, and then I'll come to Olivier.
Yep, can do. Yeah, in terms of additionality, I think that has been quite a frequently discussed question in the sustainable bond market. So I think additionality actually comes from two angles. The first one would be that investors generally prefer the green bond proceeds to finance new projects instead of refinancing existing projects. So they see that if their money is going to new project, that would likely bring a more advanced environmental benefit because the projects are newer instead of some of the old ones. And another level, maybe a more advanced level of additionality, is actually that the green bond proceeds would go to a project which would not otherwise be funded without the green bond. I would say that in the market, because I think there would be quite a lot of admin costs as well as uncertainty for those extremely new projects to be funded. So we haven't seen green bond, which is normally a credit instrument, which is based on the issuer's credit to do that. But we have seen, for example, project bond, which would quite directly link to the underlying project that could really go to the actual level of additionality. So if we issue a project bond, then the project would go for a new, for example, solar project in Vietnam, for example, that would be the real additionality. But the next layer, so maybe a lower layer of additionality, we actually see that many of the issuers are actually able to do. So for example, if you asked me this question 2-3 years ago, we would say that nearly 100% of the sustainable bonds in the market are actually only for refinancing. But now we are seeing many more green bonds are actually putting a certain percentage of new projects. For example, the Hong Kong government green bond, we are actually committed to put at least 50% of our proceeds into new projects. So I think when the market is developing in its sophistication and depth and width, the more the issuer would be comfortable about using the new project, trying to bring the cutting edge technology in order for the table. But again, I think because investors are also at the other hand, demanding quite a lot of detailed data disclosure. And then if you talk about the disclosure detail, the impact data, then the existing project who has been in operation for some years would be in the best position to provide such a data. So I think there was actually kind of fine balance here. So when we offer additionality, the disclosure and data quality may be a little bit lower because we would need time to develop accurate impact reporting data. So I think when the market develops, when issuers are more sophisticated to use the new project, that the additionality would be better to address. And then when the ESG data become more readily available and accurate, as many of the panelists ask for the wish list, the wish list, then I think when it's achieved, then I think it would also be better deal with. Then issuer would be able to bring on more new projects in the market.
So additionality through new proceeds for new projects, and maybe with better data beyond business as usual targets under SLBs and so forth. Olivier, we're a little bit over time, but the other question around banks helping their clients, opportunity for you to pitch your advisory services to the audience here.
So banks are here to incentivize at least on the loan side, we are here to provide incentives to our clients. At Natixis, we have a tool in place which is called the green weighting factor. The green weighting factor is colorizing the entire portfolio of the bank to the degree of sustainability of each of the financing that we are providing to our clients. It's allowing us to go to credit committee with 2 ROE, one conventional ROE and one green ROE. But it's also allowing us, if we believe the financing has a positive impact, to give an additional incentive as well. But clearly, that's purely internal. But globally, banks, yes, we are here to incentivize the transition. We are here to use properly what the Loan Market Association has put in place, and I see it's 3 minutes above, so I need to stop. But yes, we are here to accompany. This is the overall job of sustainable finance. This is the overall job of all of the bankers, which I see here in the audience. We are here to accompany all issuers, green issuers, brownish issuers, high-emitting industries, oil and gas, cement, steel. We are here to accompany everybody in their transition pathway if they have a sincere approach to transition.
I think that's a great way to bring to a conclusion a discussion on money and financing, better ESG performance, lower cost of capital. That's what Olivier is saying there. That harks straight back to the message I think we heard from Emily Woodland from the buy side at BlackRock as one of the things they're absolutely looking at when they look at their allocations through that ESG lens. So I apologize to those who are desperate to go out for tea. Sorry, no, there isn't any tea, so I don't need to apologize for that. But thank you everybody for listening, but particularly please do join me in thanking this amazing panel, Tay, Olivier, Juliette, Ken, Luying, and Winnie for sharing their expertise with us this afternoon. Thank you very much, everybody.